Welcome everybody to the Everyday Growth Advisors special series. We have a great treat for you guys today. If you are here for the tax webinar, you have come to the right place. I hope that you guys can hear me fine. If you can, just give me a thumbs up in the chat. I would appreciate that very much. And we have a special program for you guys today. So we have on a Zoom call Jason, the founder of OptionSwing, and Akram and Associates, who are going to be having a special tax webinar to kind of better guide you guys on how to skirt and navigate your tax season this quarter. Just to kind of give you guys a flow of the events that will take place today, we have first a introduction from Jason, the founder of OptionSwing, one of the most successful trading communities out there. And then we will have an introduction from Akram and Associates, who will be putting on a great presentation for you guys to have some great insights on tax laws and tax information. After which, at the end of the stream, we will have a Q&A session. And so I would like to get all of you guys, if you will, and you have any tax questions or tax related questions, please drop them in our chat so that we can answer them for you. Also, don't forget to click like on this stream if you enjoy it, and also subscribe if you haven't yet. This is one of those special streams that will be recorded, so if you missed it, you'll get access to it later as well. So without further ado, let's welcome Jason into the call. Hey Jason, how are you doing, man?
Good. Thank you for having me.
Absolutely. You excited for this
stream? Oh yeah, absolutely. I'm very excited for today's webinar. And just to do a quick introduction on myself, I am Jason. I'm the founder and CEO of OptionSwing. And we are one of the fastest growing financial education communities right now. And we're super excited to kind of bring you this special webinar, especially with our partner, Akram and Associates, and especially Mohammed, which I'll go ahead and have him introduce himself.
Hi, everyone. We hope you're happy and healthy and safe today. I'm Wendy Gordon. I'm the Executive Firm Manager at Akram and Associates. Akram and Associates is a boutique CPA firm providing audit, accounting, advisory, and tax services to traders, hedge funds, and family offices. We take pride in offering clients specialized service, which has earned us a reputation of trust and excellence. The Akram and Associates team really understands accounting and the industry while providing clients with a depth of expertise. We have Mohammed Akram and Annie Kelsey with us. Trader Tax Status Webinar. Mohammed is the founder of our CPA firm, and Annie works in our tax department and specializes in trader taxes. You can review our team profiles on our website at www.aifundservices.com. The topics we are covering today in the webinar are how to qualify for tax trader status, structuring a tax efficiency entity, alternative tax strategies, and harvesting tax losses. And now Mohammed will start the webinar.
Thank you, Wendy. I appreciate your gracious introduction. Thanks, Jason. I appreciate that. So, not everyone can qualify for tax trader status. There's no tax law. There is no provision in the tax law which says that if you do this, you will meet the test. But there's a lot of court cases which were happened over the 25, 30 years, which tells us what the courts look into before they decide who meets the criteria of tax trader status. So there are two tests we put together for anyone if we are servicing any of our trader clients. We say whether your trading activity is substantial, regular, how frequent you do, and it should be continuous. You can't trade for 1 week and you can go on vacation for a month and then come back and trade again. Second is tests we put together for you guys to make sure that you are capturing short-term movements in in your securities trading. So it means you should not have long-term holdings in your portfolio. It means you should have a short-term gains more than long-term gains, and you should not have any long-term gains because then you are not a trader. It means also that your qualified dividend should not be more than your ordinary dividend if you are trading during that time period. Next screen, please. So it means that, as we said, we need to make sure that TTS is available for the people who are making a living from the trading. Means if you see the West Coast traders, they wake up early in the morning and monitors position that is their regular day. East Coast traders might be trading even in the night options, cryptocurrencies, futures during the night time period because those markets are open for them. Part-time people would be trading full-time. Retirees can become a tax trader status, but IRS is very conservative looking into that and make sure before you consider this as a tax trader status, you are eligible to get that. Second is that before we go into, I want to make sure that your account size is material. Should be at least $25,000 in your trading account, because you can't say I'm a trader because but you have put only $3,000-4,000 in your trading account to start trading. You can do the testing during that time period, but if you get audited, it will be very difficult to say you can make living from that account with the $3,000. And your intention is money for your from the trading, and you can also consider as supplemental income, which a lot of people are doing due to the COVID-19. So that's the other area that we can help you on that, or you guys can strategize yourself for the trader tax status during the COVID-19. Next screen, please. Structuring an entity is the best way to proceed towards that trader tax status, because usually if you structure an entity, you will get less scrutinization from IRS, tax authorities, and the cost of structuring an entity is not more than the benefits you guys can receive from that. So I always encourage people, if you want to go for a trader tax status, structuring an entity is better than putting all your income on Schedule C for that. If you structure an entity, you can also unlock a lot of employee benefits. You can put money into your retirement accounts, you can pay your health insurance, you can pay a lot of business trader-related expenses, like the research, like the software, anything which helps you to do the trading, any seminars, webinar, education programs. If you are subscribing for option swing education plan monthly, quarterly, annually, you can also deduct those. These are the real expenses which are eligible to take deduction on your tax return. But it will be better if you have the entity to expense those rather than on your individual tax return, which you can do that, but it will get more scrutiny from IRS. TTS will not be subject to 3,000 capital loss limitation. A lot of people can lose a lot of money in the year, but if they don't have the TTS and they don't make 475F election mark to market, they will be subject to 3K capital loss limitation. Also, the war sale losses, you can limit that if you're TTS and make the 475F election. War sale losses always cause you to trigger issues with the IRS, and you have to pay, even though you have not make real money during the year, but you are still subject to pay the taxes to the IRS because war sale are triggering gain. Next screen, please. So in the nutshell, I would say there are different ways you can structure the entity. It's not, each situation will be unique. Facts and circumstances will determine whether SCorp or partnership will be better. But if you want to pay health insurance and you want to contribute towards your retirement plan, and that's a good reason to contribute that, so then all those gains will be non-taxable. You have to structure SCorp, because in order to make those deductions or expenses on your entity level, you need to have earned income. And when you structure SCorp, you need to process a salary, and this salary will allow you to deduct those health insurance and the retirement plan. Next screen, please. QBR. This is a very, by end of 2017, current White House introduced the law called TCJA, Tax and Jobs Act. And they provide that deduction 20% if you have a pass-through entity, and you can deduct 20% of your income. So if you are a TTS, taxpayer status, you should be eligible to get 20% QBS. It means if you make an income of $100,000 of gains, it means you can take 20% on that. 20,000 will be a deduction. You will pay tax on 80,000. But there are this activity considered specified service activity. It will be subject to phase out limitations, and that deduction may be reduced or limited if you are making more than $250,000. It depends on your source. Next screen, please.
Hello, this is Annie, and I'm covering two topics today: the alternative strategies and harvesting tax losses by avoiding wash sales. So as you know by now, TTS is not for everyone. If you don't qualify for TTS, Akram & Associates still has some tools in our toolbox to optimize after-tax performance rate of return. You can trade in your traditional and Roth IRA plans for deferred tax on your gains. You can trade 1256 contracts. A 1256 contract, as defined by Section 1256 of the U.S. Internal Revenue Code, is any regulated futures contracts, foreign currency contracts, non-equity options, broad-based stock index options, debt options, commodity futures options, and currency options. 1256 contracts are subject to mark-to-market accounting. It means such contracts are treated as closed at the end of the year, and unrealized gain or loss has become realized. Long-term capital gains tax rates range from 0 to 20%, and short-term capital gains are treated as ordinary income, and they're taxed from 10 to 30%. For securities, if they're held for more than a year or 365 days, you will pay you will pay a maximum of long-term capital gain rates, and if held less than a year, are taxed at short-term ordinary tax rates. Irrespective of the holding period of a 1256 contract, you will pay 60% long-term and 40% short-term capital gains tax rates. If a trader's trading business expenses are not material, they may want to skip using TTS on a Schedule C. TTS is not for everyone, but it's a pity to get stuck with wasted losses and expenses when one could otherwise have made the election to have Section 475 mark-to-market ordinary loss treatment with the TTS as a prerequisite, generating federal and state income tax refunds. If you have gains at the end of the year, you can reduce your tax bill by harvesting tax losses. Tax loss harvesting allows investments with unrealized losses to be sold and credited against realized gains, but beware of the wash sale rule. The wash sale rule prohibits selling an investment for a loss and replacing it with the same or substantially identical investment 30 days before or after the sale. If you do have a wash sale, the IRS will not allow you to write off the investment loss, which could make your taxes for the year higher than you had hoped. A common oversight when obtaining reports for wash sale tax reporting purposes is to solely rely on the broker's issued Form 1099-Bs. Although this form provides cost basis reporting information, it does not give taxpayers a complete picture. especially if the taxpayer has multiple trading accounts or trades equity options. Section 1091 requires taxpayers to calculate wash sales based on substantially identical positions across all their individual accounts, including IRAs.
Yes, thanks, Annie. This is Mohammed again. This is the last section of our presentation, how we can avoid tax expensive errors. Traders really benefit working with the CPA firm who specialize in the securities law. You can do your tax return through the TurboTax and any of the local CPA firms, but sometimes you're leaving money on the table for the IRS, and at the same time, you are leaving a lot of things. You are filing your tax return wrong, which can cause a lot of tax audits and issues with the IRS. So as we mentioned in our earlier presentation, that 475F election, which is mark-to-market election, has to be filed at certain time period. If a lot of taxpayers, when they file those taxes under the TTS, but they miss that time period, and it causes a lot of notices from the IRS and can cause the audit for them to do that. So make sure if you're taking TTS and wants to make 475F election, you're doing it at the right time. Suppose I can give you one example now. You can still make 475F election as an individual for the tax year 2020, because initially this election needs to be filed on April 15, but they pushed the date from April 15 to July 15. So we still have a time to make that election. But if you are an entity and you miss that time period, because for them the due date was March 15, right? That's a very common error we have seen on a lot of the tax returns. The other error we have seen that CPAs sometimes don't know this trader taxes. What they do is all those gains, they put as an income on Schedule C of Form 1040, which means as soon as you put the income, Schedule C will generate the self-employment income and self-employment taxes, which is 15.3% Social Security and the Medicare. So all those traders, they are not subject to this self-employment income and self-employment taxes. But this treatment we have seen several returns in our history of the firm that where people are filing the wrong tax returns. Sometimes taxpayers or traders are filing on their own, and that causes a lot of issues for them. And other is that we should not rely on the 1099B for the wash sale adjustment. If you are a TTS and you make 475F election, it means you are not subject to the wash sale rules, right? But if you are TTS, tax trader status, and did not make a 475F election, you are subject to the wash sale rules. And the wash sale rules are different from the taxpayer point of view and also from the broker point of view. Broker rules for the wash sales are for each brokerage account. But if you have multiple accounts with multiple brokers, we need to look at overall. So it means you may be saying that you don't have a wash sale, but you may be incurring a wash sale in the other account. So it means you need to take a look as a taxpayer all four trading brokerage accounts rather than what they're saying on the 1099B. And the wash sale rules are also your IRA account. Suppose it can also trigger the wash sale. If you have a brokerage account and your IRA account, and you incurred a loss and you're buying a security within 30 days from your retirement account, it means you are also incurring a loss. 1256 contracts, Annie has touched that. they are not subject to the wash sale rules, right? So it means that you should not rely on 1099B. Most of the time I have seen, like it's not really reliable because it's not right. Next screen, please. So I would say that make sure that due to the COVID-19, things are changing so rapidly. When we started this year, we did not think COVID-19 will happen, but think about our fiscal and budget deficit will be increased by 3 to 4 trillion by end of this year. And there is a chat that blue wave is coming. Irrespective of where do you stand on your political background, but I think in any case, the tax rates will be higher in the coming years. So if you have a long position and there is a risk that they will take that long-term gain rate, which is 20% maximum, they will take away from us next year or in the coming years. So make sure if you have unrealized gain, you're closing that position before the end of the year and not incurring a wash sale. So that way you are paying the lowest 20% tax. If you have other thing which I think will significantly change will be the SALT deduction. So the people who are living in the high tax states, Democrats might change that rule, which will helpful to them. But they may change the corporate income tax rates. Right now, it's a maximum 21%. They're thinking that Democrats will change to 28%. They have to raise revenues. It's not like the federal government has to increase revenues. It is cities and local governments has to raise revenue. So there will be huge tax burden is coming on us. So make sure you're structuring your business right, you're paying your fair share of taxes, not overpaying, and making sure you're getting the help you need to reduce your tax bill for this year and the coming years. The other area where lawmakers will target is the state taxes. State taxes right now, the limit is 11.23 million per person, overall 23 million. With inflation, they will decrease the limit of the exemption, may reduce. A lot of taxpayers were transferring those assets from first generation to the second generation, and it was very useful because there was a concept of step-up basis. Means if I'm transferring to my kids 5 million worth of home right now, but I bought that 15 years ago for $1 million, so means my kids can get that $1 million cost basis when I will transfer them. So that will go away in the coming years as soon as November elections were gone and things were different. So these are the little things I just want to touch base. And at the end, I would say that that please consult the right CPA firm for your taxes. A lot of people don't do that. They just go to the local CPA and that person doesn't know about all the nuances we have in the securities law, all the breaks which are available, which can save you a lot of taxes. I have helped people, they didn't make a real money, but they have to pay $250,000 in taxes because of the wash sale rules. So I want you to be proactive rather than reactive. Means I want you to be ahead of the curve rather than behind the curve, and get things in place before the year end with some competent CPA professionals. We also have on our website a lot of articles we publish. Please check out those. They are really helpful for you to help you out navigate your taxes in this year and for the coming years. There's a lot of material available for you to download and read and all that. And feel free to reach us out, and we will be happy to help if you guys need any help. Thank you, Jason, and I will just get back to you.
Excellent. Thank you so much, Akram and Associates. That was a great presentation. I can definitely say that I learned so much from that presentation. And I'm sure that a lot of people have questions, but first, I'm pretty sure that Jason, you might have a couple of questions as well. So maybe you want to ask any questions that you have in your head before we open up the floor to questions that we have on the live chat. And by the way, for people that are listening in right now, please post your questions in the live chat. We'll take your questions really soon.
Perfect. So again, thank you to the entire team over at Akram Associates for the wonderful presentation. And I really had just kind of 3 questions. The first question is just kind of open to really anyone on the team there. But just kind of going back to the wash sale rule again, is there a way that you guys could kind of reiterate that one last time and maybe give an example, just because I think that's such an important rule that a lot of people don't quite fully understand, and oftentimes it kind of bites them in the butt later. So just to make sure that everyone is aware of, that this kind of rule exists, if you guys wouldn't mind just explaining that one more time.
Absolutely. My pleasure. This is Mohammed again. What happens that you need to take a history. In a couple of decades ago, what was happening that people were harvesting losses, right? So they have a lot of gains during the year, and they just want to generate some losses. They have some offsetting positions, and they were selling those positions on or before December 31st, and then buying into that positions again beginning of January of next year. So IRS said, if you do that, you can't take that loss. You need to defer that loss into the next year, which means that your loss is not allowed. It means you will pay tax more because that loss is not available for this year. And what happens that the way IRS told brokers to do that, if there is any wash sale is occurring in those transactions, they will automatically increase your cost basis. So yes, they will defer the loss too, but also at the same time, they will adjust the cost basis of your securities. So it means it is pretty much occurring as you incur those losses. And this 30 days window is not forward, it's also before that transactions too. If IRS has no issue with the gains. IRS is more concerned when people have the loss, right? When you incur a loss on any of the securities or your investments, it means you can't buy any of the similar identical security within 30 days before and 30 days after that incurring a loss.
And perfect, thank you for that. And just to also clarify, when you consider a trade, this means for a specific company, right? So if I was buying, let's say, Tesla today, and then repurchasing that position again for Tesla, that's considered a wash sale rule. However, if I'm, purchasing Tesla today, but Microsoft tomorrow, these are different. So that's not a wash sale.
Yeah, so it means that, thank you, Jason, that's a very good point. Why? Because the loss is substantially identical, tax law. So it means when you say Tesla bond, Tesla options, Tesla common stock, Tesla preferred stocks will all be considered as one. But if you are buying General Motors or Microsoft, that will not be an issue. But means everything around Tesla will be considered substantially identical.
Perfect. Thank you. So the second kind of question that I had was around trading expenses that you're talking about and kind of what qualifies for it. So, I know me personally using things like option scanners, whether it's also like new subscriptions, different like things like that. I think you also mentioned like the option swing memberships and so forth. But are these all considered, trading expenses that can be written off on taxes?
Absolutely. Whether you have an entity structure for trading activity or not, or you're doing on your individual brokerage account, you can deduct those expenses on your income tax return. Absolutely.
Awesome. And then my last question that I have for you is one of my favorite things to actually talk to you about is kind of your backstory of Akram and Associates, and you're I guess from like one entrepreneur to another. I really kind of love your story of how you got started and kind of how you built it. But if you just wouldn't mind sharing a little bit more about your history and kind of how you guys came about.
Sure. No, thank you so much. So I have been working in the alternative investment space for the past, I would say, 20 years. I started my career with E&Y. Then I worked with a couple of other accounting firms. And then on the private side. So, but 7-8 years ago, I believe exactly 7.5 years ago, I thought that I'm not really gaining any additional knowledge, and it was a really good time for me to start or hang out my shingle on my own. And that's how I started this firm with a one anchor client. And we are 10 people firm, and we have offices in New York and North Carolina. My partner works from New York, and we have a clients from majority of our clients are on the West Coast or East Coast, and I would say we have clients from Hong Kong, Singapore, and Japan and Canada, because this securities trading, investment trading is very specialized field. Not every CPA understands that well. So if you are trading, so make sure you are getting the right help. So, and our growth rate is very impressive. In the initial years, we were around 80%, but now in the last 4 or 5 years, we have a higher base. So we are around 35-40%, but keeping my fingers crossed, hopefully. I believe COVID-19 really push us more to grow, because a lot of people are trading these days from their home. They have a cabin fever. They have staying at home. They have no idea what they need to do.
That's so true.
They are just trading. So we structure almost, I would say, 6-7 entities in the past few weeks, right? And all over the country, from Utah to Florida to California to North Carolina, because a lot of people are taking this as a serious art to supplement their income, because they are making income through the W-2, but it's a fixed fee, right? It's fixed compensation, fixed earnings, and they want to supplement that income, and they can't go to the vacation, right? So they can't spend time outside. So why not make some extra money living there? But this is all good, but make sure you're not ruining your life with IRS, because if you have those wash sale losses, it could a lot of gains, even though you didn't make real money. So it means that you have to pay the tax at the end.
Perfect. So that's all the questions I have. And thank you so much, Mohammed, for answering all those. Tarek, do you want to open it up to the rest of the chat room to see what else we have?
Absolutely. Thank you, Jason, and thank you, Akram and Associates. That was great. If there's one takeaway point that I learned from the entire webinar today, it was that if you fail to plan, you plan to fail. And I think that, this is something that all new traders should take very seriously when they're considering trading in this atmosphere right now. As Mohammed had accurately pointed out, this unique situation that COVID-19 has put us in has seen a great rise in the number of traders that have been joining this industry. And I think that, many people jump into this without knowing the rules and the regulations, and then end up making really costly mistakes. So I'm going to actually open up the floor to questions that we have over here. Thank you very much for asking these questions, by the way. I think many of them are going to be questions that we have answered anyway, but maybe people who don't understand. So bear with us, Mohammed and team, if there are repeat questions. But let's see. The first one over here is by Sandy, and she's asking, is it better to start my own LLC and pay myself from my trades from the LLC I create, or just from my trading account?
If I understand her question right, I believe that she's asking if she should be getting paid through the LLC or through the brokerage account. I think there's no difference. LLC should have a bank account, should have a brokerage account if you are creating that, but make sure you are structuring your entity right. Opening an LLC is not an issue. Making sure whether it's a partnership for tax purposes or SCorp is that, because only way you can get paid is if you are having an SCorp and processing a salary. It means you need to pay Social Security and Medicare tax being an employee and being an employer. But the advantages of having that, as I mentioned earlier, you will be able to pay your health insurance, you will be able to contribute money towards your retirement plan.
Absolutely, yeah, I agree with that. I think that's an accurate answer there. There is also a individual asking, and I think this may be a rather broader question, but maybe you have a succinct answer for him. He says, "Hey, I just turned 18, never did taxes. Can someone? I traded stock and options. Can someone simplify this for me on what I need to do?" I think this might be a very broad question, but maybe you can help him.
Sure. No, that could be a valid question for a lot of people. A lot of people got free money from Uncle Sam, like $1,100, and they put that money to work and making those trades. I'm not saying that, gentlemen. I'm just saying overall, right? So a lot of people are trading these days. So it means as soon as you open the brokerage account, you give your broker your SSN, right? And broker is required to issue the 1099B, which is a tax document, which needs to be filed with the IRS. So your broker, Robinhood, or whoever you are using, will tell IRS these are your gains and loss, dividend income, and expenses. It means they will report to the IRS before you report to them. So it means make sure when you have to file the tax return, and you need to make sure that you are trying to reconcile your tax return with the 1099B, which broker has filed with the IRS.
Great. Yep. I mean, that's definitely the way that I do it as well. But usually I ask my CPA to take care of it. Okay. Next question. Just want to make sure I understand this. Self-employment income doesn't overlap with trading income. Question. I personally am self-employed and all of my income is SEI.
Right. So there are two different sources of income here, right? When he says he's a self-employed, means I'm thinking he's making income from other channels, means he's doing consulting work somewhere and they're paying him through the 1099 miscellaneous, which is a tax document. As an independent contractor, his income is there. Then he's making some gains at if he's making TTS, he's making a 475F election, then those gains will become ordinary gains, and then those gains are not subject to self-employment income or self-employment tax. If that's not the case, and he's thinking that those gains will be his only source of income is trading, and that's what he's doing for a living, and he has no other source of income, then he's not subject to any self-employment tax, because trading gains are not subject to self-employment income if you make the right election and your TTS, taxpayer status.
Perfect. I think you answered this question. The next one is going to be, do I pay state taxes too, or just federal tax?
That's a good question. Depends upon where you are a resident of which state. There are 5-6 states which don't have income tax. If you are a resident of those states, you will not be filing any state income tax return or state tax. Some of those states are Washington, Texas, Florida. I think Alaska was one, but it's not. So these are the states. If you're a resident of those states, you will not be paying any state income tax. That's a very good question, because most of these gains are not subject to state income tax, but each state is different how they tax those when you file the tax returns, because most of the states file the tax returns on the basis of AGI, federal AGI, and then deduct some or not. But these are not the state source income.
Right. Okay. And Sandy has another question. If your account is under 45K and still a day trader as only job, is it still recommended to set up an SCorp? or entity?
I mean, I believe so. Reason is it will get less scrutiny from IRS, because otherwise Sandy has no sorry, I lost my thought, but yeah, I'm just thinking if Sandy has no efficient tax entity, right? She has to file the tax return individual. On Schedule C, she has to report all that gains and losses and expenses, which will cause more scrutiny. And she has to prove two things. She has to prove that she's DTS, means her trading activity will be substantial and all that, what we discussed earlier on how to qualify. And then she will be open for a lot of scrutiny from the IRS, versus if she has an entity, it will cause less scrutiny from IRS, but also if she structured that entity right, she can really pay a lot of expenses from there and reduce the income significantly, and it will not cause any taxes.
Right. Yeah, I think that's a really good point there. Like the fact that you can write off some of the expenses, that's a big plus there. Okay, Morris is asking, any advice on starting a business or what would be required? I can look into EIN and setting up with the state, but any other advice?
So starting a business, I'm assuming Morris is asking starting a business regarding this trading venture. Okay, so it means that venture has to be separate venture. You can't mix this trading venture with your odd jobs or with your consulting income or with your real estate income. It has to be separate. Second is wherever you are a resident of that state, you need to register that entity with that state authorities. That could be depends upon your state. And then once you have that, then means you need to open your bank account. First, before you open the bank account, you need to get the EIN, federal EIN. Mm-hmm. And you may need the state ID too. It depends if you're going to process a salary for yourself. But after that, you need to open the bank accounts and the brokerage accounts. You need to be careful making sure that all that activity was happen under the entity EIN. Under the entity brokerage account, all the expenses should be paid from the entity bank account, not your personal. So that way, you have to separate trading expenses versus your personal expenses. Don't pay your business trading expenses from your personal account. Always use the trading business bank account to pay those expenses.
That's awesome. I think I'm personally going to follow your advice on that one. Thank you, Mohammed. Okay, the next question is, let's see, we have a couple more. So and this one's a very common one, if my overall losses outweigh my gains, do I still have to report my transactions for the year? I wouldn't have to pay taxes, correct? Mark is asking.
No, that's wrong assumption he's taking, because he can, if he doesn't meet the criteria of TTS, which we mentioned the test 1 and test 2, it means he will be subject to the capital loss limitation. I'm assuming he's married and filing joint tax return, maximum loss he can take is only 3,000. So he still has to file the tax return, right? Irrespective of whether he has losses or gains, because how the IRS will know your overall picture if you don't file the tax return.
Right.
And it could happen that all brokerage accounts might report those losses and gains to the IRS, and they will not, and they are expecting a return from him, and he's not filing that because of a red flag. So that's how IRS system works for everyone. IRS receives information from different sources, from the brokerage, from the bank, from the credit card processing company. Whoever is paying you is also telling the IRS. So they're reporting all that info to the IRS, and those information what they're reporting will be cross-checked with your SSN, with your tax return. And When it doesn't match, it causes the red flags. And it means IRS agent has to go to log into the computers and make sure whether this caused any audit issue or whether notice needs to be served. Sometimes these are the computer generated notices. They have to go out. So that's how the system works. So if he's not filing the tax, he's inviting unnecessary pain.
Gotcha. Yeah, that's definitely true. I agree with that. Next question is, if someone is just starting out trading and filed for unemployment during this period of training or trading, how should he file for taxes at the end of the year?
It is very unfortunate that COVID-19 really puts a lot of people unemployed, and the irony that sometimes people are making more money during that unemployment period because of the federal government is paying $600 per week in addition to the state benefits, depends on which state you're living in. But if he meets the criteria, unemployed person can be a trader. There is no one in the tax law can say unemployed person can't be a trader because he's unemployed. No, because you are looking for a job at the same time, but you couldn't find a job because of the COVID-19. And now, at the same time, you want to make some supplemental income through the trading, you can still achieve that as long as your trading is frequent, active, and you're trading the market movement. You're not holding for a long term. Means you're spending at least 4 hours a day. That is a pretty much task that you need to spend at least 4 hours in a day during the trading days.
Awesome. So 4 hours is the golden number. Okay, gotcha.
So and that time is not only trading. That time could be covering up research, could be anything which relates to the trading.
Gotcha. Okay, interesting to know. That's definitely important. Next question. Are taxes calculated on individual transactions or on the year-end profit loss?
So what happens is you make those transactions on every day, right? Those transactions accumulate over the year, over the period, right? And at the end of the year, all the losses will offset with the gains. And if you have a net gains or net losses, you will pay the tax accordingly. So yeah, if I understand this question right, yes, you have to pay the overall year-to-date profit and loss. And think about, unless you are TTS making 475F an election, you will pay tax only on the settlement date, means on the cash, means all the transactions which you have closed during the year. You will pay tax on that. If you have unrealized gain or unrealized loss, which you have not closed the position, you will not be paying any tax on those transactions. Reason? Because you have not received the cash. How you can pay the tax?
Okay, great. Next question is it advisable deducting from 401k to trade it oneself? What are the negative and pros on the implications? So she wants to deduct the 401k to trade for oneself.
Let me understand deduct 401. So she doesn't control that retirement account, right? So someone is managing money on that 401k. She's just contributing to 401k. There is an advisor over there. I'm making all these assumptions. And that advisor, so he's saying, he or she's saying that if he wants to withdraw from that 401k, I would say first make sure if you're taking that money from 401k, make sure you're opening the traditional IRA account. I believe the 401k is also a traditional retirement account. So make sure he or she is opening a traditional IRA account, retirement account, and then transferring the money in that 401k from his or her old employee to the IRA where he or she controls, and then make trades over there. Don't bring that money, please, from your retirement account to your individual accounts, because you may be subject to pay some taxes on that. But if you in the need of money, you need to pay the bills under the CARES Act, they have allowed people to withdraw money from the retirement, and they will not be subject to the penalty and interest, but you still have to pay the tax on that withdrawal. So I think he or she should consult his CPA or someone to give the whole scenario and make sure we are not missing anything.
Gotcha. Next one's not a question, but we just want to let you know, HDS Fitness says that this probably saved me $5,000 on my taxes already. Kudos. So,
Awesome.
the next question is by Ashton, and his question is, if my SCorp election is set under insurance cells, should I wait to change to day trade until I get to 25K or start changing the structure now?
Can you please repeat one more time? I want
Absolutely.
to understand the question right.
No problem. He says his SCorp election is set under insurance cells. Should he wait to change to day trade or until he gets to 25K or change the structure of the SCorp now?
Okay, so I'm assuming that person has the insurance business. And when you say insurance cell, I am assuming he's in the insurance business. He has the insurance SCorp. So he wants to switch this to insurance to trading and all that. My suggestion will be, please structure a separate entity for the trading and don't mingle that trading entity with any other of your venture. Means if you want to do consulting or insurance or anything, or you want to do selling on eBay or e-commerce, anything you want to do in a separate entity. Don't mix your trading activity with any other venture. So I suggest him to structure a separate entity for the trading whenever he wants to do. And he doesn't need to have 25,000 from the beginning, but overall, at some point, he should reach out 25,000 worth of money in their account. So that way we can make, God forbid, if he gets audited, we can tell our IRS that he's taking it seriously, he's spending enough time, he's trading every day, and that way he is a TTS, and then he can transfer. For me, it's good for you to have SCorp for the trading, and you can transfer some money to your retirement account and make all those gains and losses non-taxable. Like I personally have my retirement account and I transfer money from SCorp to there or other ventures, and I trade more from my retirement accounts rather than my individual accounts because or the business accounts, because if I incur a gain, I have a gain, it means I have to pay 30 to 40% tax on my gain because I'm at the higher tax bracket. So that means setting money aside for the retirement is a good way to structure an entity, and all those gains from those retirement accounts are not taxable.
Okay, perfect. And then the next question is, let's see, I'm going to pick a good one since we are a little short on time here. So what is the percentage you pay on tax for a winning gain?
Right. So obviously you pay the tax at your own effective tax rate, right? At your personal tax rate. So if it is a long-term gain transaction, and you will be paying maximum 20%. Its long-term gain rates are 0 to 50 to 20%. And the short-term rate starts from 10% to 37%. So all those gains and losses will flow on your personal individual tax returns, and you will pay the tax in which tax bracket you fall into and whatever is your effective tax rate at the federal level and the state level.
Right. Okay. Yeah, that makes sense. And then somebody else is asking, why an SCorp and not a C-Corp? And I think we'll take one more question after this one. So this question is, what about an LLC? Can you send gains to an LLC?
Can we send gains to LLC, or can we send gains from LLC? I'm not sure what this means.
The first question was, why a S-Corp and not a C-Corp? And what about an LLC? Can you send your gains to an LLC? I think that's what he meant to say.
Okay, so here is a C Corp is not a best structure, period. I have been in this business for the past 15 years, and in the securities trading, I have not seen a single entity which incorporates a C Corp, even though under the TCJA they reduced the rate from 37 to 21%, but still C Corp is not the best because that 21% rate starts from the first dollar you make. Second is, and in the future, that 21% rate would increase to 28% based on the Biden campaign. It means C Corp. I have incorporated C Corp in the last 2 years. I may close that C Corp next year as soon as they will increase the rate to 28%, and they have to increase the rate. So C Corp is not a best option because you will also be losing QBI, because think about, you will pay lower tax at the pass-through level, at the SCorp level. You will pay based on your tax bracket. It could be 15, 20% or 16%, depends which tax bracket you are. And then at the top, you will be able to deduct 20% QBI under the TCJA. So things are very fluid. Things may change. We may structure something now, but in the next year, rules may change again, and we have to restructure all of those things again. But I would say that, and especially if you have SCorp, you can, as I mentioned earlier, you can allocate money towards your retirement and contribute towards your retirement account and have free taxable gains. The other question was how we can transfer gains to the SCorp. I really didn't understand the question.
That's fine.
To the LLC.
Don't worry about it, Mohammed. It's all good. You're a real sport for doing this on a rapid fire round, by the way. Honestly, I have not met a person who can answer so many questions in such a short period of time and be so on point. Honestly, kudos to you, man. Thank you so much for doing this. Akram and Associates, you guys have been a great help to our community, and I can't start to imagine the amount of help that you have given to everybody who's been asking the questions here. So I want to take this moment to really give a warm appreciation for you being here, taking your time out from your busy schedule, and attending this webinar, which is so important for our community and everybody in the YouTube community as well. And also a special thanks to OptionSwing for sponsoring this event and also supporting this event that is powered by the Everyday Growth Advisors live stream. So I want to kind of put an end to this webinar right now, but also leave on the note that you guys are awesome. Thank you for putting in the time here, and we hope that we can hear from you soon again. Who knows? Maybe we'll have a part 2 someday.
Sure. No, I thank you so much for giving me the opportunity by you and Jason. I really appreciate and really enjoyed that. These questions were phenomenal. I really love those because it tells me people are starting thinking about the year and now, and which is the right thing. I want people to be ahead of the curve rather than behind the curve. They need to think those things now versus at the end of the year. That's not a winning mindset. If you are going to think about your taxes after December 31st, it means you will lose.
Absolutely. Yeah. As I was saying earlier, right? You fail to plan, you plan to fail. That's the name of the game. And so I want to, leave them with that note. Thank you, Jason, for organizing this as well. Appreciate you so much as usual. Well,
great. Thank you.
Absolutely. We will end the stream right here. Thank you guys for attending the stream, taking out time from your busy schedules for being here. This stream will be rendered and uploaded to YouTube in maybe an hour or so. So check back if you didn't watch some parts of it. And as usual, remember to like and subscribe so that we can have more content like this for you guys. Till next time, guys. Have a good day. Bye-bye.
Have a great afternoon, everyone.
Thank you. Thank you, guys.
Excellent. We're